And welcome to everyone who's joining. We'll be starting shortly.
Maybe Adam, give me a heads up when we're ready to go and when you can see you've got enough participants.
Yeah, we see people joining.
People trickling in.
Well, let's wait a little longer then. Welcome to those that have joined us already.
Dave, it looks like you're joining us from Napa today.
Kind of looks like it. Yeah,
Quite the background.
It's appropriate for you. It's really did just for you, Jeff.
Thank you.
For those that don't know, Jeff is affiliated with Matthews, his family's winery, which has just got quite the coup here. Well, I guess actually the coup happened a couple of years ago, but it's now coming to fruition. Appropriate word with your wine. So the Quilceda Creek winemakers now have their first release coming out soon. Is that right?
That's right. Yeah, full time. Obviously, we've been working together for 16 years, but my family owns a winery in Washington, so we have new winemakers from Quilceda Creek. It's been fun for us, and just releasing some new wines that we're proud of. And so, anyways, noticing your background, and it looks a lot like he's from Washington. So, I
think it's actually Europe, but
yeah, it looks like
anyway. Okay, Tuscany. Yeah, it could well be. All right, so thanks again for everybody that's on here. It's after 11 o'clock, so let's get going. And we're going to follow our usual format, which is where I ramble for about 25 minutes or so with some relevant slides. And then we get to the highlight, which is the Q&A. So please hold your questions until that time and just make notes as we go along if I catalyze anything in your minds that you want to ask me about when we get to that section. And we've heard from Jeff Otis already. We'll see a little bit more of him coming up here in a moment, but we've got everybody's favorite slide, the disclosures here, which we'll be ignoring, moving right through. And I'm always told when I do these things that we should have some kind of image that breaks the ice. So I thought this one was very appropriate as the ultimate icebreaker. So I mentioned that, I really didn't mention this, but I should, that this is for you folks out there, our founding member tier, or at least those that are considering doing that. And also you're considering Evergreen because you did indicate some interest in Evergreen's capabilities. The idea is that with the founding member tier, it is a premium service where in addition to the 2 newsletters that we put out for our regular subscribers, paying subscribers, as you know, we block the content for those that aren't paying about a third of the way through each newsletter. But for a founding member tier, they actually get another communication weekly, and it's one I select that I think is particularly interesting from another source. Then we do these webinars, which allows you to ask questions, and I can be a little bit more open with talking about ideas because we do have some pretty sophisticated people that are part of the founding member tier. They're actually, in some cases, money managers themselves, or they're just highly sophisticated investors that manage their own money. So it's definitely meant for the people that are, that are more serious about investing. But for those that are preferring to outsource, and it continues to be my belief that particularly when you get into the income area, the bond world, but also other cash flow generating securities, that's a really tricky thing for people to do on their own. So I think we have had some folks that have hired us to manage the yield part of their portfolios, and while they do it themselves with their equities. So we have some slides at the end that are particularly oriented towards the do-it-yourselfers. And then I mentioned earlier, Jeff, here he is. And he is a partner at Evergreen, has been with us for about 16 years. He is responsible for relationships that have over $600 million of assets, and he's been a very valuable member of the team for, well, really since day one. He hit the ground running pretty fast. And he will be participating with the Q&A. He'll be asking some questions, and so he'll help things move along in that regard. So this is the theme of this is, am I wrong? And this is a quote from one of my favorite sources, Kevin Muir. Instead of seeing something and immediately saying the market is wrong, I begin with the assumption that the market is right and I'm the one who is missing something. Certainly, those are wise words when it comes to being in our position when we're managing other people's money and we have to make decisions, and a lot of times with very conflicting or incomplete data. So it's good to go through this exercise, I think, and particularly right now when it does seem like things are at some kind of an inflection point. So the key areas that I could be wrong about are the recession, the stock market, interest rates, inflation, oil prices, commodities in general. I guess other than that, just kind of minor stuff. But let's start with the raging recession, soft landing, no landing debate. And I think that a lot of you realize that I've been in the recession is coming camp, and we're not officially there yet. But I do have to remind people a lot of times that back last year, 2022, the first two quarters were down. We had down GDP. Some people thought we were already in recession. I didn't think so. It wasn't confirmed by GDI, gross domestic income. We'll talk more about that. That tends to be a more accurate measure of the economy. But right now, I don't think it's any exaggeration to say that most of Wall Street and certainly the Fed believe it's going to be a soft landing or not at all. The problem is their track record is pretty awful. Goldman Sachs, which got a lot of press here recently when they said only 15% chance of recession. I mean, they completely whiffed the last time we had a real recession, which was in 2007, 2008. We'll ignore the COVID recession. That was really a kind of artificial thing. I think we would have actually had a recession at that point, but that was more of a flash crash, not your typical type of long drawn out process, which this one is much more like that. And the Fed, if you don't know this, they've never called a single recession in their history. They're 0 for 17, and that's despite the hundreds of PhDs and all the supercomputers they have that are part of their team and their approach. It's pretty embarrassing, really. But if you look at the bullish data out there right now, there is a fair amount of it. And I think it's important to concede that. And when you look at industrial production with computers and other related equipment, semiconductors, very strong. Industrial production, aerospace, and defense, that's not surprising given the war in Ukraine. But that's also tending to be stimulative to the economy. So it's clear there are parts that are looking still quite robust. And if you consider CEO confidence, it crashed and was looking very recessionary, but it's turned up in a fairly significant way. So maybe we're through it. Some people said the recession already happened. We've had a series of rolling recessions. That's another one of the theories that's out there right now. You may have seen Amazon is hiring 250,000 workers for this upcoming holiday season. I think that's up from 150,000 roughly last year. So that's a vote of confidence. U.S. nominal GDP, which includes inflation. So usually when you hear people say GDP, they're talking real GDP, ex inflation, but including inflation, which is what kind of drives economic activity. It's been a tremendous surge since the pandemic. It's up about 40% in nominal terms. And of course, so much of that is because of the trillions of dollars of government deficit spending, the so-called stimmies. But that money in many ways is still out there and still coursing through the system, though at a decelerating rate. And one thing that, that's kind of like economics 101 is the belief that higher interest rates actually are contractionary to the economy. But what if they're stimulative? And there actually is a school of thought out there. I don't totally agree with it. I sort of agree with it, that these higher rates actually add to economic activity. It's certainly true for the wealthier companies, the companies that have a lot of cash or more affluent consumers who also are sitting a lot of cash, and that cash was earning nothing a couple of years ago. It's now earning 5%. So that's a positive boost. Now, the other side of the coin is all those consumers and businesses that are hurt by higher interest rates. And we'll look at just how severe this interest rate change has been coming up. And it is possible that this, I mentioned earlier, GDI, which stands for gross domestic income, so that's like the corollary to GDP, that perhaps it's going to get revised up because of these higher rates. And there's actually been a little bit of evidence of that here recently. So again, I'll put that into the positive category. And this is something the Wall Street Journal is picking up on, kind of the tale of two companies or corporations, tale of two consumers, those that have that are more flush and or they termed out their debt. So think about homeowners that were smart enough to refinance their mortgages back in 2020, 21, when they could get 2.5% or 3%. The higher interest rates don't hurt them. But if you're a company with a variable rate debt, which a lot of companies are, especially the weaker companies, it's a different story. But again, we'll focus for now on the positive, and it's definitely boosting earnings. You think about Microsoft or Apple or Google on their big cash hoards, they're raking it in right now. If we look at the Chicago Fed's National Financial Conditions Index, it certainly doesn't look like there's a recession anywhere in the vicinity. We're going to look at one coming up that looks quite different. But for now, this is one that, I'd say is definitely a source of comfort. U.S. household income after inflation is also rising, though there have been some revisions here lately. There was actually one downward to real sales, and that's real disposable income has actually been lower for the last 3 months. So some of these more recent economic data points are actually coming out on the softish side, but that's really not appropriate for the positive part of this. I'm going to look at some of the challenges coming up. And here's another one to look at the upside. What about the stock market? It often rallies starting in October. We're in October. Now, sometimes it really gets hit hard before it hits that rally point. But when you look at these two things, and this is on the left, I think is the most important, these are credit spreads. So that's the difference between what corporate America pays to borrow money and the U.S. government pays to borrow money. And you can see during COVID on the left there, the cost of capital went screaming. And that's when the Fed intervened and they actually started buying corporate bonds to bring those spreads down. That's actually what caused Evergreen, my firm that I'm co-CIO of, to go really all in at that point. We thought that was an incredibly bullish development, which it turned out to be, fortunately. But at this point, credit spreads are, they're just pretty relaxed. Now, very recently, they have been starting to pop up a little bit. So it's something to keep an eye on. Volatility, you hear perhaps or read about the VIX, that's the volatility index. And that had been very low recently. So also, no warning signal at all there. But that has definitely popped up here because of this weaker market that I'm sure you're all reading about. Earnings forecasts have turned up. That's bullish, though I do question the validity of those earnings estimates. I think they're way too optimistic, but nonetheless, that's what's happened. Interest rates, we talked about the positive side, but basically longer term interest rates, when they go up as sharply as they have here recently. And for some of you that have been reading my newsletters here, I've been warning about this really ever since they broke above the prior peak. The prior peak on the 10-year Treasury note was back in October of last year. So just about a year ago when they hit 4.3, then they went all the way down to about 3.5. Then they start going up, excuse me, a little water. I'm almost over COVID, but not quite. So anyway, the rates went up sharply last year. They came down, and now they broke above that high from a year ago, and they've now soared. Actually, they hit 4.9% on the 10-year Treasury earlier this week before backing off a little bit. So on other positive on interest rates, it's looking like the Fed is close to done hiking. In fact, there's a good chance the tightening is over. Won't know that for sure. There could be one more rate hike, but I think, that is the positive, is that the Fed is pretty close to ending one of the most aggressive tightening cycles ever. However, they're still shrinking their balance sheet. And that's an important one a lot of people forget. That's a form of like stealth interest rate increases. That's quantitative tightening, the opposite of their famous quantitative easing. So there's still that tightening that's occurring. Inflation is a positive. It's come down a lot from the peak back in the first half of last year. There has been, the white line is CPI. The other is core CPI, which tends to be less volatile. There's been a bit of a pop up here in CPI, maybe because energy prices have been rising until this week, that is. Talk more about that in a bit. But nonetheless, this is a positive, core inflation. And it could get even better because the rent factor is a really big part of the 40% of the core CPI. And it's done based upon the Fed's kind of funky owner's equivalent rent. And that's definitely cooling off. It's basically assumes what ask people, does a survey, what would you be able to rent your house for? And it isn't very scientific, but they use it. But just no question that rents are cooling off, and that's positive for lower inflation, or at least a disinflationary trend. Payroll growth also cooling dramatically. That's good up to a point. I mean, what's going to get interesting is once things start to really look bad in the employment market, which I think is coming, then that's when you start to really raise the the red flag about inflation. I'm sorry, about a recession. But so far, this has been good in that it's keeping inflation under control, and it does cause some people to think that the soft landing is a probability. I'm skeptical. Oil prices, now this is interesting. Things have changed so radically, but they had about a 30% increase from June to a week ago. And when I created this, I said, it could be that because I've gone up so sharply that there could be a pullback coming up here. And that's definitely what we've seen. So to update this chart would actually bring the line back down closer to 80. So oil has gone through a very significant correction just out of the blue. And the point I was making even before that happened with this particular image, this dotted blue line is looking at gasoline prices versus personal income. So it really is in a very non-threatening position right now. You look back to 2008, right before we're in the thick of the Great Recession, and oil prices were consuming a much higher percentage of income. So that's a definite positive. It also means that oil prices could go up quite a bit before they create any demand destruction. If we look at commodities other than oil, lots of cooling there too. Lumber's way down, wheat's way down. A lot of these things peaked when during the invasion of Ukraine, and there were fears of, legitimate fears of acute global food shortages and even mass starvation, which fortunately didn't turn out to be the case. If you look at lithium, copper, and aluminum, those have also come down significantly, and they're part of they're some of the key elements in the great green energy transition, particularly lithium and copper. So that's kind of odd, but there is a real shakeout going on in the renewable energy space. Those stocks have been really crushed lately. If you haven't been tracking it, it's been one of the worst performing areas of the stock market. We'll talk about another one coming up soon that's maybe a bigger negative. This is really good news, and I don't think most people know it. I mean, I was shocked when I saw this, which is looking at the trend in Medicare spending, which had been just relentlessly going up, and it seemed like it was completely uncontrollable. And this is really encouraging to see this. One could wonder, what would the deficit be, which is terrible right now. We're running a deficit of as a percentage of GDP that's about 8%. And that's in dollar terms close to $2 trillion, which is unbelievable and horrible when you've got unemployment at such a low level, sub 4%. It's never happened before. And if Medicare had maintained its prior trend, it would be even worse. Maybe we should try to put the person who's in charge of Medicare spending in charge of the overall federal budget, and things could look a lot better for our country. But right now, unfortunately, it's a very ugly picture, and I think that's got a lot to do with what's happening in the bond market. So, am I going to just throw in the towel and say that I've been wrong and that we're not going to have a recession, or at least anytime soon? And no, I'm not. I'm actually becoming more convinced with every passing day that the risk of recession are increasing, not decreasing. And I apologize for those that have read this in my newsletters or heard me say this in various podcasts, but it's pretty daunting to think about how many parts of the economy are already in recession. Corporate profits, the manufacturing side of the economy, government tax receipts, which are plunging lately, and then gross domestic income, which I keep mentioning because it has been more accurate over time than GDP. Because remember, last year when GDP was down 2 quarters in a row, GDI was not in a recession. Now it's obviously changed. It's gone slightly below the line. There have been some slight upward revisions. So I think it's fair to say it's just kind of right on the edge of being in a recession, kind of bouncing around a little above zero, a little below zero, but certainly much less robust than GDP. And GDP is notorious for getting revised, and it gets revised to be more in line with GDI almost all the time. There's some other warnings out there too. The Fed's very important beige book, that's one of their most important national documents where they track markets all over the country and what all the regional Fed guys are seeing in their particular area. And it's pretty obvious that the warnings of recession from that have just gone absolutely postal. Real bank credit is contracting. That's very rare when GDP is still growing. Real average hourly earnings are actually down 2.9% at an annualized rate. It's the worst ever. It's one reason why I think a lot of people don't feel nearly as optimistic as the government statistics would lead us to believe. We're also seeing part-time jobs growing while full-time jobs are actually shrinking. That's not a particularly great sign either. Ironically, the IBD just came out with a poll that's Investors Business Daily their economic optimism poll, they call it, and it was shockingly unoptimistic. So that's another sign that maybe consumers are feeling the heat. I think this is kind of consistent with that. But also, people will often ask me, when would you be more optimistic about the economy? And my answer is when the forward-looking rather than lagging economic indicators actually improve. And we do have a series that's been around for decades called the Leading Economic Indicators, or LEIs. They've fallen for 17 straight months. They're called leading economic indicators because they lead. They anticipate what's going to happen in the economy. Whereas, for example, the jobs market is the ultimate lagging indicator. So we've never, just to be realistic, we've never avoided a recession previously. And the LEIs have been contracting for even 12 or 13 months, much less for 17 months. If we look at credit card delinquencies, they're obviously looking very, very ominous right now. No, I really kind of marvel that there isn't more attention on this topic, that we've got as I mentioned earlier, say 8% deficits to GDP, or, roughly $2 trillion. And that's, that doesn't, if you back that out, the economy is actually contracting already. And you just can't keep sustaining those kinds of deficits. And even though they're stimulative on a short-term basis, on a long-term basis, they actually act as a drag. And that we can see that this century, where we've had government debt explode, and yet the growth rate has actually gone down. So that's called a negative multiplier. So we're actually, for every dollar of incremental government spending, we actually get less than $1 of economic growth. And I think that is going to be a problem once we start to get a little further past this tremendous explosion of government spending. We'll start to see the drag effects from that. And of course, we've got the UAW strike right now, where they want significantly higher pay for less work. They want to have a 32-hour work week. I don't think they're going to get that, but they'll probably get a lot of what they want, and it doesn't augur well for productivity. Strikes in general are really proliferating throughout the economy. So we've just averted another government shutdown for 45 days anyway. That's all it is that they've extended it by. But it does call into question. I said that I think the debt ceiling is kind of a distraction. The real issue is what I've been calling the 4F scenario, or the federal fiscal funding fiasco. And this idea that they've let deficits just get so out of control that they have to raise all this new money, sell all these bonds, and it's happening at a very inopportune time. Because overseas investors who used to be voracious buyers of U.S. treasuries, are now actually sellers, particularly Japan and China. And the U.S. banks are selling too. They have way too many treasuries. That was the treasury exposure that brought down three big banks. Three of the biggest bank failures in U.S. history happened this year because they had too many treasuries. So it's a real problem when the government's got to raise over the next year and a half about $3 trillion of new money, and they've got to refinance about $14 trillion of existing debt. And so you've got the potential for things to really get sloppy in the bond market, and they already are. And this is no longer just me saying this. This is a reality. We'll see a little bit more on that in just a moment. But what we've already seen in terms of the bond market wealth destruction is epic. And we hear a lot about the stock market wealth increase that's happened since the pandemic, which is true. The stock market's up quite a bit since 12/31/19. But what we don't hear is how much wealth has been destroyed by bonds. And it's $70 trillion globally. This is one example. This is a long-term U.S. Treasury that was issued back in the summer of 2020 at a yield of 1.25%, basically doing 30 years, doing 2050, and it's down over 50%. And this is one of the worst wealth destructions in the bond market in history. So it's, you got to be realistic. Yes, it's true that the stock market has been strong, but these higher interest rates have taken quite a toll. And that's another way to look at why interest rates matter to stocks, is that stocks do kind of have to compete with bonds. And what this image is showing us is that stocks are quite expensive relative to treasuries. And that, if you can get a 5.5% yield on a short-term treasury, that's pretty tempting. And so stocks have got a lot more competition from yield instruments than they had certainly a couple of years ago. With oil, there has been this decline. I was looking for a bit more than a shallow pullback than when I first created this. But if we look at inventories, they are really, really low if you adjust for all these hundreds of millions of barrels that have been released from the Strategic Petroleum Reserve And yeah, there can be corrections. The oil market's extremely volatile. I was actually expecting a correction, as I put here, but I didn't think it would be quite as deep as it's been. But no, I thought could certainly pull back to the 80s where we are now. I don't think it's going to get a lot lower than that just because there is such an acute shortage of oil. So it's I think that's going to be another problem going forward. Is I think we're going to see oil trading into the hundreds, pretty routinely as we get into next year. And then this is what I was referring to earlier. We looked at one financial condition index, the Chicago Fed, that looked pretty positive. This one is more concerning, and it's deteriorated a lot here recently. And then our partners at GovCal, they also run one that's kind of similar, that's also flashing orange, if not red. So it's on that particular one, not quite as positive as maybe is popularly believed. And this is the really important chart, I believe. This is looking at the long-term trend, basically showing the 40-year decline in interest rates that started in the early 80s under Paul Volcker. That's when 10-year treasuries were yielding about 14%, or even a little bit above that. They hit their low in the summer of 2020 at just about 0.5%. So tremendous decline in interest rates over a 40-year period. I was a bond bull for most of those 40 years, but really flipped to the bearish side in the summer of 20 when those rates got down that low, and where I was convinced that the government's response to COVID was going to be inflationary. So this is clearly a major change in interest rates. And as I said, we actually touched 490 here the other day on the 10-year treasury, just a huge increase from where it was even just in August. And I think that's why you're seeing the stock market behave in a much less friendly way here lately. And this is reminiscent of what happened back in October of 87, where interest rates went up very quickly. They went from about 8.5 to 10.5 back in the autumn of 1987, and then the market really got clobbered. Another flashback to that's what's happening with utilities. If you didn't know this, they've been absolutely hammered. They were actually, this shows what they did back in 86 and 87. And you can see really severe decline. They went down about 29% at that time. We're looking very similar to that now. And the utility index is down 27% from a year ago. It was down 5% on Monday, or almost 5% on Monday alone of this week. So utilities absolutely getting crushed. Not a great sign, because they are very interest rate sensitive, and that has the ability to spill over to the rest of the market, which is what happened back then. So just quickly, some charts of interest, because we do have people I know that want some individual stocks to look at. And these are companies that recently made new multi-year highs. That's always one of the ways we try to screen for companies that are acting well, that have momentum. Southern Copper is one. They are a beneficiary of that great green energy transition I was talking about. But there's some other ones here that are maybe a little more blue chip. Smucker, the famous jam company, that they're going through some indigestion right now because they bought Hostess, which makes Twinkies, but the stock has been pretty pulverized, so it may have basically gone down as much as the purchase price of Hostess. PennyMac Mortgage, it's one of the few mortgage companies that actually benefits from higher interest rates. It also broke out and had a pullback. And what you can see from a number of these is the pullbacks are not minor. And I'll have a comment on that and look at some of the other stocks that didn't make the cut. UBS is one that I highlighted kind of in a stealth form back last spring, when they got an absolute steal of buying Credit Suisse, and the stock pulled back a little bit, got to the upper teens after that happened, and then just took off. And it still looks actually kind of interesting. Becton Dickinson, the blue chip U.S. medical device company, it made a new all-time high, then pulled back a little bit. Not a bad one to have on a watch list. Berkshire Hathaway, of all these charts, Warren Buffett's company, looks arguably the best. It's had the most contained pullback, and it's a stock that we've owned for years and years and years at Evergreen, and it's obviously done very well. But I went through about 150 stock charts to select these, and frankly, most of the other ones didn't look too good. So it looks to me like there's a lot of subsurface erosion going on in the stock market right now. And, since I created this, actually, there has been further weakness in stocks. And so we're going through, at least superficially, a somewhat mild correction in the stock market. But it's interesting, you look at broader indices, because the S&P 500, as I think we all know, has been so heavily influenced by the Magnificent Seven. If you look at, for example, the New York Stock Exchange Composite or the equally weighted S&P, they're actually negative on the year. So another sign that below the surface, the market's not nearly as strong as it looks when you look at just the S&P alone. So could this be another October to forget? Well, there have been a lot of them. I mean, it's just very odd that so often October is where we see big market declines and then often big rallies. And even in 1929, where that was one of the most epic declines ever in October of that year, there was a massive rally that happened after that. You needed to sell into it because the market was poised to go down for the next 2 years, and got to one of the lowest valuations ever. But I don't think we're looking at a replay of that. I'm not even saying we're looking at a replay of 1987. But if you had bought into 1987, you made a ton of money coming out of that. So that's really kind of the key message I want to end with: is don't panic. You want to be ready to be greedy when others are fearful. And my experience is, unfortunately, most investors tend to freeze up when prices go into a free fall situation. And so, we're prepared. I mean, we've got a lot of cash. We're being very disciplined and careful about how we redeploy that cash. But I think we could be on the cusp of a really terrific buying opportunity. So this is just kind of some appropriate humor here based on what we were looking at earlier with this just disastrous federal budget. Congress passes $1 trillion stopgap bill that will fund government until about 2 p.m. tomorrow. It's not quite that bad, but it's pretty bad. So with that, let's get to the very best part. And here's some questions from all of you. Jeff Otis, I know you have some.
I've got plenty. I don't want to jump in front of the line, but I'm happy to.
Yeah, go ahead.
I was going to ask you, and then we'll get it back into markets, but based on your history at Evergreen, managing money for 45 years, I think, in this world, and so many different clients that you've worked with over time, from our side of the desk as wealth managers, what do you think makes for a good client fit versus a bad client fit?
Well, that's a good one, because it really is a critical, it takes two to tango, at least to tango successfully in the financial markets. Somebody once said it's hard to be smarter than your clients. And I think one critical thing is patience and taking a longer term perspective. And we found, as you know, I think you know this better than I do, that those clients that watch their portfolios the closest tend to do the worst. The ones that look at their portfolio sometimes multiple times a day, and they get into a time when the prices are falling, even if they're holding up, pretty well, they still see the negatives and they freak out, and then they say, well, we better get to cash. And we just see that happening time and time again at the wrong moment. By the time they decide that we've got to go to all cash, it's when you really want to be buying. So yes, that's critical. And I think people that are willing to kind of understand what's going on, not just look at the price change. I think that there's a tendency to say, well, if this is producing a positive return, let's say the NASDAQ, it's got to be good. And if something is producing a negative return, it's bad. And when things look the very best from a return standpoint is often when you really need to be in a profit-taking mode. And when things are absolutely getting crushed, you think about energy back in 2020 during COVID, during the lockdowns, and the price of oil on the futures market went negative. Well, it was a multi-generational buying opportunity for energy, but you had so many people saying energy is uninvestable, and Jim Cramer screaming that on CNBC every day. And it takes a lot of a high emotional IQ to resist all that kind of pressure from the disinformation that's out there on a regular basis. I think that's a very critical part of being a good client. So I hope that answered what you were asking.
Yeah, I would think a lot of the subscribers to the Haymaker are traditionally do-it-yourself investors that are interested in your thoughts on markets, but still wanting to implement their own investment strategies. So I was just curious, for Haymaker followers that could be potential clients, which ones would you think would be the best fit for us versus those that maybe should continue managing it on their own for the time being?
Right. That's well said. And I think a way to do a kind of a self-check along those lines is to look back at these prior times of extreme price movements, either up or down. So when the market, I call it the peak insanity of 2021, the kind of everything bubble, and that's when the GameStop and AMC were going absolutely ballistic, and you had tremendous speculation in SPACs and NFTs and profitless tech and on and on and on. I really do think it was the biggest bubble of all time in human history, actually. that, were you taking profits? And in fact, I put out a newsletter at that point, and man, I got so much negative feedback from people saying, "What do you mean take profits?" And I said, "Look, I'm just saying take some profits. You've had quite a run. It might not be a bad idea to take, put 20% of it, in cash." And or, conversely, when things have really been pounded, like, were you during 2008 when the markets were in free fall, were you buying? Were you buying during COVID when the market was down 37% in a few weeks? And if the answer to all those things is no, then I think you got to say, well, am I really doing this right? Do I need a professional? And you might not. I mean, there are people that are good at managing their equity portfolio and are pretty good at timing, but I think they're rare. And as I said earlier, I think where they really need help is in the bond world. And let's face it, they used to be, I was joking, they were kind of back to certificates of confiscation when they were so low, when the Treasury got down to 0.5% or 1% and inflation was starting to explode, and they looked very unappealing. But now you've got some serious interest rates out there. And so I think a lot of our readers tend to be a little bit more mature in their life cycle, and cash flow and principal preservation are and should be very important to them. So I think that's where we really can provide a lot of value to our clients.
Yeah, maybe one follow-up question on just what you mentioned. If someone's listening and they hear you and they are interpreting you as someone who doesn't like bonds right now, is that fair? Is that valid? Or are there areas of the bond market that you think are attractive and you would own currently for clients?
Thank you. Yeah, that's a great question. And it's something I agonize about, because typically when you get to the point where a recession looks likely, you've got this inverted yield curve where short rates are higher than long rates. And then it kind of starts to uninvert, which is what's happening now. That usually means you're really close to a recession and you want to extend maturity. You want to buy longer term treasuries. The problem I've got with that kind of normal playbook that I've used for decades, is that if we are in a situation where the treasury market is getting overwhelmed by supply, and you just think about the Fed, they were the biggest buyer for 15 years with all the fake money they created out of their, what I refer to as their magical money machine, and now they're a seller. And these foreign central banks that were huge buyers of treasuries, they're sellers for the most part, and banks. So it's a daunting situation. And so you're right, though. There are parts of the bond market that are attractive. I think kind of that 3 to 5, maybe 7-year kind of short to intermediate term part of the treasury market, where you can still get 5%, lock it in for a while, but you don't have a tremendous amount of inflation and interest rate risk. Because I do believe that in the next recession, the policy response is going to be very inflationary, kind of like what happened during COVID. And that's why I think you could have long-term interest rates really take off again. And you could have, perhaps along the way, a really powerful move in some of the commodity areas. But back to the bond market, yes, there's corporate bonds that look attractive. There's one that we bought here recently, yielding 9.6% with kind of intermediate term maturity. It's generating a lot of excess cash and buying back their own debt. And so you can really pick up a lot of return by looking at some of these corporate bonds that a lot of folks are unwilling to buy. We tend to really focus on the BB rated part of the bond market, which is high grade junk. And the reason is those have very low historic default rates, like less than 1%. So there are definitely places to be where you can get attractive yields. And so, yes, I don't want to be interpreted as being negative on all parts of the bond market, but I do worry that we haven't seen the worst of the treasury bond markets off, though I do think there are going to be some rallies. We've had enough of a decline that maybe there's going to be a bit of a rally here near term. Already has been a little bit of one, but I still think the trend on longer term treasuries is to higher yields.
So, David, what do you think of gold?
Well, I like it, but I try to be realistic about it, because it doesn't do great when you've got interest rates going up as much as they have here recently, because gold obviously doesn't pay anything. So it has to compete with yield instruments. I think the reason you own gold is because you believe what I said a moment ago, which is the government is going to be put into a very difficult position in a recession. Because you think about if the deficit is 8% of GDP now, and in a recession, it always goes up significantly. It can be 12, 13% of GDP, and just enormous amounts of debt that have to be sold to finance that. And there's not going to be enough buyers, which then does that force the Fed back into the QE mode. They're much more familiar position of buying treasuries with the money they just conjure up out of their computers? And I think the answer is yes. Now, I also believe Jay Powell's not going to go along for that. I think he will resign before he gets back into that kind of mode. So for now, I think gold is going to continue to kind of bounce along. It'll have some strong rallies when people think that, perhaps the Fed is in a position where they're going to have to start cutting rates. And I do believe gold will have a big rally actually before the Fed starts easing. It will, when, perhaps unemployment gets to the point where people go, yeah, this is going to be a recession for sure, maybe even a deep one. And then they start anticipating the easing. And that's when gold has another one of its big run-ups. But I think for right now, it's kind of fighting some headwinds. Same with silver.
For anyone else who has questions, just feel free to unmute yourself. I guess that's the way we're doing this, and ask away.
Hi, this is Fred Sauer. I just wonder, talking about gold, are South African gold mines, some which even pay a decent dividend, are they still safe in the current social environment there?
No, we pretty much stayed away from those. Ironically, I just talked to a friend who lives in South Africa earlier today, and he is always regaling me with things about how unstable the grid is. And I mean, I just don't really understand that economy. I think there's easier and safer ways to make money on gold. So we tend to prefer those that have their, kind of North American and maybe in some South American countries. But, I'd say at right now, something like an Alamos AGI, which has been a good performer for us, it's gone up in a tough gold market because they've got some great new mines coming on. But Agnico Eagle, AEM, that's another one of the better gold miners. So we tend to focus on those guys. I think with some of these South Africans, you can get some really big dividend yields, but I would question how safe those dividend yields are. So that's a little bit, when you buy gold miners, you're taking plenty of risk and you're assuming a lot of volatility. I don't think you need to kind of pile that on by going into South Africa. But as I say, I'm not very knowledgeable about that. So take that with a big grain of salt.
Thank you.
Sure.
And yeah, we'll leave plenty of time for anyone else that has questions.
David, I just wanted to tell you, I went to an art exhibit of Edvard Munch the other day, and they had a terrific painting. It was entitled Haymaker, and I thought of you. And I'd love to send you an image of it if I could, but I'm not sure how to do that.
I'm sure it's a little better than our image that we have down in the lower right here. Our little Mike Tyson thing, wannabe. That'd be great. Thank you.
I ask, which is your view of inflation in the relative short to medium term? In the sense, I believe that inflation has started going up and will go up strategically for a long period of time, more or less like the 70s. But it looks like we are in a correction, and if a recession does come, that is deflationary or not inflationary. What do you think about inflation for the next, let's say, 24 months? Thank you.
I think you described it pretty well. I would agree with what you said. I think we're going through a temporary disinflation period, and it will probably get more so if we go into recession. So, you said, I think that like the 1970s, and I think that's what this decade is going to look a lot like. And we did have similar periods in the 1970s where the Fed reacted belatedly, just like they did this time, to the inflation surge, and they raised interest rates a lot. Got the interest rates finally up around inflation, then inflation fell. So then you had real interest rates, which we have. So that means that interest rates are higher than inflation. That's been very rare here in recent years, but it's happened here recently. So then, though, what do they do? And that's where I was really getting to this next step in the event that there is a recession. Does the government really panic and decide that they've got to get it back into a very stimulative, fiscal and monetary both? Which is what created so much inflation coming out of COVID, right? It wasn't just the Fed printing money. They were doing that, been doing that since 2008. But you had the federal government sending trillions of dollars directly to people, and the combination of the two, and the Fed basically, again, creating the money to allow that to happen, because the government didn't have that money and they couldn't sell that many bonds. So the Fed basically monetized the debt, very much what we used to make fun of third world countries, banana republics, for doing. And we did exactly that. And guess what? We got double-digit inflation as a result, at least for a short time. So if they have to respond to recession, especially if it's a deep recession with all the debt that's out there, that's where I think that that's the real challenge. It's not like when Volcker took interest rates to 20% in the early 80s. The government debt to GDP at that point was about 25%. We're there, and add another one to it, so 125% debt to GDP currently. It's just astronomical. And of course, it's way more than just the government. I mean, we get a lot of corporations that are highly leveraged. And again, there's the Microsofts of the world and the Googles and Apples and a lot of companies that are in great financial shape. But I think where markets and economies are driven is at the margin and by your weaker borrowers. And those guys are starting to just absolutely hit the wall when they're paying interest rates as high as 12% right now. So, can the government play as hardball as they did 40 years ago? I don't think so. I think at some point they're going to fold like cheap lawn furniture, and we'll have basically kind of a replay of what happened during COVID, with a lot of fiscal stimulus and a lot of monetary stimulus, and that the inflation cycle will take off again. The other thing I would say about inflation is I think that there are structural drivers today that we haven't had in a long time. Talk about the strikes. I mean, strikes are much more prevalent, and they've just absolutely taken off. And these big settlements that you're seeing, even a couple where there aren't strikes, but just one little factoid is the average UPS driver now makes $170,000 a year with benefits. That's pretty big pay. And you got to believe it's up tremendously from where it was. And I think that stuff kind of gets embedded in the system, and his wages are sticky. And then I think you have to look at the misallocation of capital, even if it's for good intent, with the great green energy transition. It already has been very expensive, trillions of dollars expended. There's going to be trillions of dollars more expended, and with probably not the best return on investment. I alluded to it earlier that the poor performance of these renewable energy stocks is shocking, and I think does indicate that perhaps there's a problem with this, that there's starting to be a lot of pushback. And particularly when you see coal plants being built in Asia, almost a new coal plant opening every few days, and the West starts going, why are we doing all this stuff? And are we really going to bankrupt ourselves? Look what's going on in Europe right now with EVs, and the fact that China is the world's largest exporter of autos from a standing start a few years ago, and a lot of those are EVs. And so the U.S. has got some tariffs and barriers that's not happening here, but it's definitely happening in Europe. And it's like, are we going to really let our economy become beholden to the Chinese? I don't think so. But in the meantime, I think that trend towards that renewable energy is inflationary. It's what I call greenflation. But there's others, as far as trying to bring back a lot of production from overseas to the United States. I mean, it's the opposite of the globalization that was going on. It's deglobalization, and in almost all cases, it creates higher costs. So a lot of these things are really kind of structural, and you can get these cyclical disinflation periods during recessions or slowdowns, but then inflation reaccelerates, and that's certainly was the experience in the 1970s. So very good point to bring up, and I obviously have strong feelings about that. Did I fully answer your question?
Yes, great, thanks.
You're welcome.
Quick question about copper. I mean, China is having problems with building and everything, so they'll buy less copper, but the so-called green revolution needs more copper. Where is the balance there? Is it positive for copper or negative or neutral?
I think in the long run it's positive. If we do stay on this path, and maybe that's the big if. I mean, if he'd asked me that a few months ago, I would have said no question. We're going to continue to push in the West for this great green energy transition. But now I think there's doubts, and I still think it's going to happen, but I think there's more uncertainty about that. So it is going to be more of a tug of war between, because you're right, there's been a lot of copper consumption for construction in China. They've clearly got a real estate bust of epic proportions going on in their property markets over there. So they're going to be using a lot less copper. On the other hand, when you look at EVs, they take something like 3 to 4 times as much copper for every electric vehicle as does a traditional car. So if, we're assuming that there's going to be millions more EVs on the market over the next 5 years, you would think copper demand would be very strong. It's really hard to create new copper supply. So I think there will be times where it becomes very short, kind of like what's happened with the uranium lately, which has been one of our favorite plays because of the tremendous nuclear renaissance, and uranium prices have been quite strong. I think that's going to happen to copper at some point. But if we're in the early stages of a global recession, which I think there's a decent chance, that's going to kind of put a lid on copper prices for a while. And I think when it comes to the overall green revolution that you mentioned, that requires a tremendous amount of government financing. And that's where this whole thing that I was bringing up earlier about the federal fiscal funding fiasco could have serious implications for that renewable energy transition. If they don't have the money, they've been throwing trillions of dollars at this process. If the financing tap gets turned off, that's really going to be a problem for these renewable energy plays. And that could be why they've been so weak lately. It's really pretty stunning to see how much some of these have come down.
Well, one comment, you're in Britain, they had this high-speed railroad system. They canceled it because they realized they can't fund it anymore.
Did you say in Britain?
In Great Britain, in England, they had a high-speed railroad system planned for some $50 billion or what. They canceled it because the government there realized they can't fund it. So maybe the same thing will happen here with the green revolution, that they at least cut back on some of those.
Why I'm so bullish on uranium is that I think there is an epiphany in the West that, their tremendous hostility towards nuclear energy has been misplaced. And especially when they look and see what's going on around the rest of the world, particularly in China. So you've got 60 major nuclear facilities under construction around the world, none in the United States, of course. We had 2 that just opened, but there's nothing else coming. But in China, they've got 20 alone, and plans eventually for another 100 or so over the next roughly 15 years. So they're going very aggressively with nuclear. And we've got technology that's actually very encouraging. Instead of these big light water reactors that, like the 2 that came on in Georgia, the cost between the 2 about $30 billion, $15 billion per gigawatt. Instead of those, the trend is towards small modular reactors. And that's an area I'm very bullish on. I think we're going to see some great breakthroughs, already are seeing some great breakthroughs. So I think that's part of the optimistic scenario for humanity, is if we can get, fusion is probably still decades away, but if you could have affordable and safe fission, which is really what these SMR, small modular reactors, offer, particularly the molten salt variety, could be extremely bullish for humanity. I hope so. We need something. Still got a few more minutes if we're going to try to do a noon cutoff, noon Pacific time. Well, anybody else have anything? Been some good questions.
Great questions. While people are thinking, I'll just do a quick infomercial on Evergreen. So our firm that Dave's the co-CIO of, we manage about $4.5 billion now for various high net worth and ultra high net worth investors. Primarily use Schwab as our custodian. So clients set up accounts at Schwab, we help them do it, and we then oversee assets at Schwab on behalf of our clients, like you would expect a property manager would, right? And we have different strategies for different clients. It all depends on what the goal is and risk and return and all that. And we custom run everything on behalf of each individual client. So Dave's heavily involved in a lot of the macro and the research, guiding then our investment strategies. And we're happy to do follow-up conversations with anyone that's interested in looking under the hood at Evergreen and how we would build things out and how we could oversee a portion or more than that of what you have.
So just to kind of build on what Jeff just said, that we're trying to provide services to pretty much anybody out there. So if you're really in the camp of I want to manage my own money, we want to provide you with the tools to help you do that. We know that that's an important segment of the market, and we're not trying to say, you're foolish to do it. I just think, be honest about how well or poorly you've done in that regard. And again, I think it's really tricky when it comes to the yield world. But we're also obviously a money management firm. And I do think that helps me, frankly, as far as writing these newsletters that I send out to you all, is that most of my competitors, fellow newsletter scribes, don't manage money. They don't have a big research team that can help them, provide them the kind of data that I come up with on a weekly basis. And, we're certainly not always right. We're going to get some stuff wrong. It's just part of the game. But I've harped on this. I harp on it almost every time I talk, and any kind of a big picture presentation. This 3-year trading range thing, I think, is just huge. And where it's really critical is, frankly, when they break 3-year support. So this whole idea that it takes a lot, something's got to be going either really right on the upside or really wrong on the downside to break out of these multi-year ranges. And we found 3 years is kind of a minimum. Frankly, the longer, the better. And the classic example I give all the time is look back at Microsoft. From 2000 to 2013, the stock went nowhere, despite the fact that they had tremendous earnings growth over that period of time. But it was just so expensive coming out of the tech bubble. So we had all those years. The market did the same thing, by the way. So just, people say, oh, it always goes up over, give it enough time. Well, 13 years, the same thing with the S&P. It went nowhere. And then they both had major breakouts in 2013, and it was off to the races for the S&P, it was off to the races for the NASDAQ, it was off to the races for Microsoft. But I know that was a huge buy signal, one that I kind of missed. We got it right with Microsoft and Apple and a few others, but I certainly missed it with the S&P. But anyway, I'm kind of rambling a bit, but that's critically important. And I think particularly if you're managing your own money, the thing that really clobbers people is when they get these positions that are too big and then they start going south and they write them down, and especially if you dollar cost average into that. So I think it's really critical to have some kind of risk control on the downside. And that's one that we think is one of the most effective we've ever developed. End of that infomercial.
In the chat on this call, I added my email address and my direct phone number if anyone wants to follow up and schedule a time. And again, we're so low pressure as a firm. There's no pressure to work with us, but if you're interested in exploring that, we're happy to. Otherwise, obviously keep subscribing to Haymaker, and Dave will keep providing a lot of his insights along the way. He's good at doing that.
Lots of insights. Some are actually insightful.
Maybe a couple. Any final questions before we adjourn?
All right, sounds like we're good.
Appreciate
Thank you
for joining us. We'll do these again.
Have a good day. Thanks for your participation.